likely to open. Cameron Peacock joins us now from IG Markets in Melbourne. And Cameron, what do you think? I mean, is it going to be a pretty flat start, do you think, for our market?
Yeah, good morning, Bridie. Look, unfortunately, you're right. I think we're looking at a fairly lacklustre open for our market today. As things stand at the moment, we're currently calling it dead flat, looking for it to unwind right around that 43.94 level where we finished yesterday. There's nothing really definitive in the way of leads from overnight. US markets were essentially flat on very low volumes. We had the Dow up 0.1%, the S&P down 0.1%, the Nasdaq essentially unchanged. Markets, I think, seem to be in a bit of a post-QE malaise. We obviously had a very good run-up in the recent weeks, in the lead-up to the German Constitutional Court vote and, of course, the FOMC decision on Friday. But now, markets really seem to just be going through that consolidation period. Last night we had a little bit of economic data out of the US. We had the Home Builder Sentiment Index reaching its highest level in 6 years. We saw the Q2 deficit coming in at 3% of GDP, down from 3.5% of GDP in Q1, which was good news. We also had Derek Fisher, the the Dallas Fed president, coming out, and he is a non-voting member of the FOMC, but he did come out and say that he would have voted against QE3 because he didn't believe it would create, or have enough of an impact on creating jobs. And that was really a high-level Fed member verbalising a lot of the concerns that people do have over QE3, that it won't create jobs. So that was an interesting comment. And then you touched upon Europe, slightly weaker on continuing concerns that Spain is not going to seek a bailout and accept some of the ECB's conditionality for bailout terms. And on the back of that, we saw a little bit of weakness in equity markets, and we saw the euro continuing to retrace from that sort of 130.95 level down to current levels in the 130.30s. But just reiterating, looking at a fairly flat start today. We did see the US dollar modestly higher last night, but we did see commodities continue to push up a little bit. We had copper, zinc and aluminium all a little bit higher. We saw a little bit of profit taking across the nickel space. Pleasingly, we saw iron ore prices up a further 4.5%. They're now trading just shy of $110 an ounce. That's going to help some of our major miners today, you would think. We did see Fortescue yesterday, obviously the story of the day. It was up 17%, trading or closing at $3.50. I think just before I came on, it was matching up another couple of cents. And we've got BHP's ADR suggesting the local stock will open up about 4 cents today. So maybe a little bit more money flowing into the materials sector, but all in all, a fairly flat day ahead, I would think. Yeah,
interesting too. Just on Fortescue, we've seen UBS come out and upgrade the stock to a buy from neutral and up its price target to $4.50 from $3.80 there. Just getting word of that from UBS being quoted on Dow Jones Newswires there. Just overall, to the sort of sense that you got from trade last night and the previous session, what do you think? I mean, is there a bit of questioning about whether QE3 will actually work to bring down the jobless rate in the US, or do you think it's just a bit of a pause and this rally will continue?
Oh, look, I think we've had this debate, over the last 6 months on this will they, won't they go down the path of QE3. Those that were against it were certainly suggesting, look what happened with QE1 and QE2. We saw an initial stock market rally. We saw commodity prices push higher, but then that wore off, that enthusiasm wore off and the effects wore off, but the jobless rate hasn't really moved. I think we've been above 8% for something like 43 consecutive months, and I think there was some analysis done by one of the investment banks saying a $500 billion program might have an impact of 0.1 or 0.2% on the unemployment rate, so bringing it down from maybe 8.3% to around 8%. So a lot of money being spent and a lot of money being pumped into the economy for very minimal impact on the jobs front. And as Richard Fisher said last night, he would have voted against it because he doesn't think that it's actually going to have the impact of creating more jobs. So that debate's certainly going to play out. In terms of can the market rally continue? Well, yes, it can. It's just a matter of getting a broader participation in this current rally. I think the rally we have seen in the last couple of weeks has been on very light volumes, and we really need to see those people sitting on the sidelines convinced that we can see this rally continue and they can bring that money in off the sidelines.
Cameron, thank you very much for that.
Thanks, Bridie.
Cameron Peacock there from IG.